Jimmy, you did have the lowest inflation read in a couple of years. But where's your rally? Where is the rally?
Yeah. Well, it's not here today. Let's answer that question first off. But I think there's a simple explanation for what's going on in the market. I think the stock market right now just is in fear of a recession and really believes the recession is going to hit. You can see that right now out of the corner of my eye. I'm looking at the year-to-date returns for the S&P 500 versus the NASDAQ versus the Dow. Round numbers, the S&P 500 is up 7.5%. The NASDAQ, which, as we know, is heavily populated by the FANG stocks, is up 17.1%, and the Dow is flat on the year. Now, the FANG stocks for the last 15 years have been the place that investors go in slow to no growth environment. That's been the only place to get growth in earnings in a slow or no growth environment. And the market is just screaming right now that it thinks a recession is coming. To me, actually, I think this is a good setup. There's been a lot of damage done in cyclical names, a lot of damage.
Underperforming today, obviously.
Underperforming today, and you can see that in the Dow versus the NASDAQ. There's 100 basis points of difference. If you start to get indications that this recession is further away, and Friday's labor report was such an indication, when you get those indications, it sets up the cyclicals from these very low valuations to rally nicely.
Okay, Jenny, take that on, because the New York Fed's own recession indicator spiking today. Cyclicals, as we said, underperforming. There's a lot of concern about where this economy is heading. Inflation, I think the word of the day is sticky. Yes, it's down. It's not down that much. And it's going to be, an aggravating fight to try and get it lower. And we'll see what the Fed's going to do. This doesn't clinch anything in terms of what Santoli had to say earlier, which I think is a fair way of assessing. Pause, most likely. No clinch on anything.
You know what was interesting? Yesterday you put a chart up from JP Morgan and it said, here are expectations of what's going to happen tomorrow morning. And this was what happened. It was already baked in, right? This is what there was 50% plus odds of happening. And so where I think we are is, I'm not sure I entirely agree with Jim that the market's just really fearing a recession. I think where we are is in this incredibly opaque environment where nothing really points too strongly in either direction. And what do we know the market hates? The market hates opacity. The market wants clarity. And we're muddling through this earnings season, but even earnings haven't given us functional clarity, because what we've seen is some really excellent numbers, a lot of beats. But then what was guidance? All the guidance, not all, almost all the guidance was saying something like, but we had great earnings, but we're not going to raise for the rest of the year because there's too much opacity. We don't really know what the landscape looks like. So to me, what I'm looking for, what I'm waiting for, is some kind of clarity. We need.
How are you going to get that? I mean, where are you going to get that from? I hear what you're saying. I think everybody's waiting for that. But you act like it's just going to show up. What is the clarity you're looking for?
This is not a wonderful answer because it's really painful. I think we need 2 more quarters of earnings. And I think we just need to get through that. And nobody likes patience, especially in the stock market. The market hates to employ patience. But how else are we going to get there other than having another quarter under our belt, another quarter after that under our belt? And then maybe you see that whole we don't know what the rest of the year looks like, therefore we can't forecast and we're not going to raise. Maybe we're past that. The other thing that I really struggle with is this neither here nor there multiple on the market, which is we're still hovering around 17.5 times. Yeah, I know we can make the argument that the big guys take up a lot of that weight and that everything, like the other 490 components of the S&P 500 are well under the 18 times. But by and large, we just don't have cheap multiples out there.
Well, the problem is, I think Jim is undeniably correct. Recession is the overhang. That is the overhang, no matter how you want to throw. The reason why we can't get out of the range that we're in is because we're fearful of a recession. We're fearful that multiples as they exist today are not the multiples of tomorrow, that the great earnings that you referenced a moment ago are not the earnings of tomorrow.
But yesterday we were saying the debt ceiling is the overhang.
No, but that's the nearest term overhang. Because it's, as we said, the market has this tunnel vision. Today, it's the debt ceiling. Tomorrow and every day thereafter, so to speak, is recession fear. And until you break that, you can't get out of the range. What do you think?
I think you're 100% correct. And the word that I would use is the market has no breadth. And you need that. It's too narrow. The focus is on rotating away from cyclicals into growth at a reasonable price. And that leads to an environment where energy's down once again today. Why? Concerns about demand weakness. Financials are down once again today. Why? Concerns that the consumer is weakening that the consumer is going to be faced with needing to extend maturities on debt at a much higher money factor. Go inside the inflation report today. Look at airlines, look at hotels, look at new cars, all indications of a consumer that is now becoming cost conscious. But yet, used cars were actually higher. So you have this cost conscious consumer. We are absolutely in an environment where the economy is contracting. You want to say you're searching for a universal recession? Okay, fine. I've said many times on air, I think the industries and sectors that are most critical to the U.S. economy are already in recession.
And maybe coming out, Joe.
Yep.
Housing, right?
Technology coming out.
But housing's going to come out first. I think it's already doing that. You know, I mean, yes, mortgage rates now at 6% plus. You know, that's still high, but it's off of the 7% number from a few months ago.
What's your view, Surat?
Yeah, look, I mean, everybody's kind of talking about the same things here, right? There's no catalyst in the short term, right? And actually, the only thing we're all staring down is every headline you read is, oh, we're nowhere close to the debt ceiling today. So why would you put capital to work in front of a 2-week uncertain period? And to everybody's point here, we just don't know what earnings are going to be. So where do you go? You go to your safety stocks. You go to the FANG stocks. Where do you go in fixed income? You go to treasuries, or you go to very short term. And there is capital going into treasuries. There is capital going into short-term savings, just to, as people are kind of don't want this other 20% correction that we've had 3 of them in 4 years. So I think the safety plays are going to be, you know, whether you agree or not, the high multiple stocks. But I think there is value in some other stocks. They're the healthcare stocks. They are defensive stocks that you can be in.
You know where you go? You go to Organon. Speaking of healthcare, OGN, Jenny.
Right.
New buy.
So, you know, I've been sitting on cash for a long time. And one of the things that I love about Organon, by the way, it's a spinoff from Merck. It's spun off in 2021. And what it is it's kind of everything Merck didn't want. It's all of their slower growers. So it's 3 main businesses. It's women's healthcare, established brands, big old brands like Singulair and Nasonex that lost exclusivity but are still minting a lot of cash, still producing a ton of revenues, and then biosimilars. So a drug called Halima, which, for example, is a competitor to Humira. So you've got this company, right, that was spun off. Spin-offs, which Surat and I were talking about just before the show, have been really orphaned. Nobody's paying attention to it. It's a company that's going to produce $1 billion of free cash flow in the next year, trading with a $5.5 billion market cap. They have all the cash they need to cover the dividend, which is 5%. There's very little economic sensitivity. In fact, most of their revenues come from overseas. So not only is there little economic sensitivity by nature of its business, but also by the nature of that they're not even US based, so you don't even need to worry about a US recession. There's kind of like 6 to 8% earnings growth ahead, 5.5 times earnings multiple. It's not exciting, but it's exactly where I want to be right now. I don't need to worry about the broader market picture.
What about healthcare here?
Healthcare.
Surat said that's where you want to be. Jenny, you know, puts the money there.
Yes.
What do you think?
And healthcare is where I am, and it offers the correct balance of growth, value, offense, defense. Big Pharma has rewarded the investor, whether it is Eli Lilly, which is trading like a biotech, or Merck, which we've talked about ad nauseum on the network for the better part of the last 13 months. I think these are the places that you want to be. I also think you could look at the biotech trade. I gave yesterday CRISPR Therapeutics as a final trade. I think that stock is breaking out right now. It goes above 70. I think the biotech space is getting re-energized, and a lot of the reason for the new energy there is because we're searching for growth. And biotechs find you that opportunity where you can see that growth.